So in this video we're going to look at what is investment and what determines investment. First of all, investment is something different in macroeconomics to what you might think in common sense. So investment is defined in macroeconomics as any spending by firms that increases the capital stock, that increases the amount of physical capital of a firm, and it is not individual saving. It's not, I'm going to invest in some shares. That in macroeconomics means that you are not spending your income, and that is your personal saving. So investment is firms buying machinery, computers, buildings, lorries, etc. It's physical capital. And of course, why do firms do this? They undertake investment in order to make a profit. And of course, it's a risky business. Investing means a firm is making assumptions about what will happen in the future. So they take a risk in order to make a profit in the future by investing in capital stock. And hopefully this might increase their productivity. So what do we mean by gross investment? That's just all investment, but a net investment is gross investment minus take away what we call capital consumption, or sometimes capital depreciation. So capital consumption is when capital wears out over time and needs replacing. So for a firm, you might have a fleet of lorries. Eventually they need repairing, or they might need replacing. You might have a building for your factory, needs a new roof, for example, to stop the rain coming in. That would be called capital consumption or capital depreciation. And it would be excluded from net investment, which is new additional investment. Okay, so firms undertake this investment. What determines the amount of investment that takes place in a country? It's often about 10 or 20% of aggregate demand. So first off, monetary policy. Many firms to invest borrow from credit markets, from banks. The higher the interest rate, the higher the profitability that you need on an investment. So if interest rates were to increase, there will be less investment taking place because you need a bigger return on investment, so fewer investment projects are worthwhile. So higher interest rates mean that there'll be lower levels of investment and vice versa. And of course you can criticise that because firms will obviously realise that in the future interest rates could increase or could fall, so they need to take that into account. The easier credit is to obtain from banks, the higher the investment levels will be. But of course you could also you could reinvest your profits, so we'll come to that on point 5. Number 2, this is perhaps emphasised by Keynes as particularly important because, as I said already, when you make an investment, you take a risk rather, and you think about the future. And you need to be confident, don't you, to take a risk. So you need to think as a business person about the future of the economy. Will the investment pay off? And how do we measure business confidence? We basically do surveys of the population, or the business population, and we ask, in a year's time, do you expect your business to be more profitable or less profitable? Do you expect your revenue to increase or decrease? And so that's how we measure business confidence. It'll tend to be low before a recession. It's a leading indicator. It tells us what's likely to happen in the future. And so investment is a key forward-looking indicator for the economy, and particularly emphasised by Keynes. He talked about the business person's animal spirits, how they feel about the future. And then thirdly, we of course have government policy. If you had easier regulation on, for example, health and safety, then firms' costs will be lower and the more investment might take place. If you had lower corporation tax, then profitability will be higher and greater investment may take place. If you had a simpler tax structure, then maybe more investment might take place. Right, a fourth area is national income. If national output is increasing, that'll tend to push investment up. And to understand that further, look at the video, the lovely, excellent video, maybe, on the accelerator, okay, which I've produced. So that's national income. Again, in a recession, investment is likely to fall, okay. So look at the video on the accelerator for that. And then last but not least, in some ways, you have profits, because many firms retain profits, what you call retained profits. From those, they can invest in new machinery, new capital, in order to make a profit in the future. So sources of funds for investment can be banks from the money markets, they can be profits, or there could possibly be new share issues. If you issue new shares on the stock market, that's another potential source of investment funding. Okay, so these are the main factors that determine investment, an important part of the macroeconomy. Okay, thank you very much for watching.